Okay, this is Timing Strategies client blog update for Friday, September the 19th. This is being posted on Sunday. I wanted to give a little time to digest things and kind of add some intelligent comments to the commentary as best I could for what it's worth. Not that it's going to be correct, just my best estimations. By the way, this is not a recommendation to buy or sell or take any investment position whatsoever. This is just communication purposes for clients only. If you have any questions, please feel free to give us a call or an email. That said, let's get going. Well, obviously what's going on is, and I'm going to try to keep my opinions out of this, but it's not good with what this Treasury scheme is trying to devise to bail out all the culprits and the cause of this. It's not free markets. It's blatant intervention and manipulation and basically trying to push on a string on multiple strings. And ultimately, I think it'll fail, but what's it going to do in the meantime? Very difficult to gauge because of the massive interventional powers of a printing press and computer electronic printing presses of the government. So again, to give you an intelligent commentary of what I think is going to happen is just, to be honest, it's a coin toss. It really is a coin toss because there's so many new variables, massive new variables, or variables that were not as significant previously that are now incredibly larger in a 48-hour period than they ever were in the markets. And you've got basically the Treasury or the government with their giant sledgehammer trying to smash things in the direction they want it to head. And then you've got the global markets, foreign countries and so forth that are probably at the other end of that receiving sledgehammer smack. So what I'm going to tell you I'm going to do is going to change based on the market conditions. How we're going to handle it is also really dictated by the market, which is going to be very noisy and deceptive in the short term. So long story short, how is this going to go? I've got some lines laid out here. If you look at some arrows, and I've kind of changed the grid here for how we manage things going forward. A price close above this 1260 level on a daily basis that does not expand on a range basis to a close significantly higher, much more higher than the highs of yesterday's high on the S&P of about 1280 will be a temporary buy signal. Now that said, we already were long from the 17th of Wednesday of last week, September 17th, 30% in the indices, 35% in sector funds, and also 10% short government bonds. Now, we took a portion of that off Friday of the indices, so that now we're only 15% long indices, 35% long sectors, energy, metal, and materials, and still 10% short government bonds. I may add to that if we, like I said, can get a close above that level, the 1260 level that closes potentially above that high of yesterday at about 128 on the spiders, but not too high. Anything higher than about 129.50, forget it. We'll not add or put that long position back on. What I am actually looking to do is if we get a move before we get, and everybody sees this gap, which is a bad, before this low gets taken out, let's just say. If this move stays inside, and my thoughts are that we're going to get an inside bar for tomorrow, somewhere within here. Nobody's going to commit. Nobody's going to want to commit to anything. It's just going to probably, and this is just my estimation, I could be dead wrong here, but we'll probably get an inside bar tomorrow, sometime within somewhere within the range of Friday's range. Eventually that bar will break. My estimation is whether it breaks up or down is a coin toss again. If it breaks down, I'm not going to do anything. If it breaks up, again, before closing that gap that we have underneath us on the spiders, before it breaks lower, I may add to that long position again with the intent and understanding that if we get to the S1 level right here at about 1320, 1335, which would be about 132.50 to 133.50 on the S&P or the spiders, I will be a seller. A seller at the S1 level of about 40%, or I'll go flat at least the long positions. If we get up to S3, which is about 137.5 to 138.50 on the spiders, I'll be a big seller of about 60 to 80%. If we get this move that takes us down below the lows of yesterday to basically close this gap that we've got, somewhere down into this range back again to the 1160 area, then that'll determine what we're going to do next. If we want to add a little more on the way up, looking for a bounce into the election, or if that is going to be a losing proposition, buying into a massive meltdown. A meltdown is very possible. And I don't know how probable it is, again, with the government sticking their finger in the pie all over, in everybody's pie. And so to give you the understanding is that I don't know what's going to happen. I'm just going to manage very conservatively. And with that, I'm going to have small position sizes and just kind of let the market kind of take me where it's going to go without too much thinking about what I want it to do. Also, let's go to the GLD, because gold is a big factor in this matter. All right, so what I'm looking for in the GLD is basically a test back up into that channel on the GLD up to about 94.5 to 95, somewhere up in this level. Over what time period? Is it going to be concurrent with the market? I don't know, but ultimately I think that should take us up there. We already have a long position in gold in the GDX, or the precious metals. Let's take another quick look at the TLT for the bonds. Beauty, baby. We went short 5% there. We went short another 5% using the RIDEX inverse government bond fund there. So we have a total short position as of this point, so which we're going to average it out basically. So between there and there, it's going to probably be something like that. Halfway between, we've got about a 10% position short as of right there. Let me just put a note. Short 10%. Boink. Doink. 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 All right, so we're short 10% there in the RIDEX government bond fund. That said, I am looking to get aggressively short the government bonds. First pullback, first any kind of, it's going to be subject to interpretation, but to say the least. Any kind of pullback in government bonds, baby, I'm going to short those things. I'm going to go look to get 20%. I'll put a note in here. 20%, at least 20%, somewhere in this range. Back up in here if we can get a retrace, or even back up just enough to take out this level of the highs, back up to where we were before the garbage that happened over between Thursday and Friday. So I am looking to get short government bonds. And then if we look at the XLE, problem with the XLE, yeah, it's oil driven, and that's a bad tick. We didn't get that tick, obviously. There's a lot of bad ticks in this e-signals database. God, I can't stand e-signals sometimes. Oil and energy are definitely going to be a beneficiary no matter what the fools in Washington and Wall Street try to get away with. But is it going to benefit the paper stocks, and is it going to benefit, the XLE and so forth, and, the precious metal paper stocks? There's going to be a disconnect, in my opinion, between the metals, the actual product, the physicals, and the paper stocks and the companies of those. Also with the XLB on the materials. How it's going to trade out, I believe that the metals, the energy, the materials, things of that nature, the physicals are going to go higher. And it's going to create a drag on the papers themselves, while you're going to see a disconnect between the metal, the energy, and the material, actual physical components versus their stocks. So how that plays out with the GDX, good question. I don't know that answer either, but I'm still seeing things that are kind of giving the picture here a little more of a clarity. And as soon as I get more of what I can communicate to you, I will be more than happy to update it. So again, back to these S&P, that's where we're at, looking for the trade potentially down to this 1160 area, at least back down to the 120, 1200 level on the Dow, or excuse me, the S&P. And if that happens, we may add a little more to the longs, but if we don't get that gap closed and we head up here first, then we'll look to sell all of our long positions and start getting short at S1. If you have any questions, please feel free to give us a call or an email, and all the best of luck to anyone that might be out there on their own as well.